the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring to you the story behind the major developments in the banking space. In this episode, our cover story is about whether credit on UPI will cannibalize the credit card market. For our Banker's View segment, we are joined today by Sanjay Agarwal, MD and CEO of AU Small Finance Bank. In Banking for You, we will try and find if there is a definition of what a fintech is. Later in the show, we will ask Tamal Bandhopadhyay if public sector banks have a culture issue. At the end of the show, we will share the results of last week's poll and the question for this week. Earlier this month, the Reserve Bank of India gave UPI a leg up when it allowed credit lines on the platform. How is this move going to affect the business of credit cards? Raghu Mohan checked it out.
The Reserve Bank of India has allowed banks to offer credit lines to retail customers over the Unified Payments Interface or UPI. While this has come as a boost to UPI, it has also raised the question, how will it affect the business of credit cards? To understand this question, let's first look at some UPI numbers. In volume terms, in March 2023, India saw 8.7 billion UPI transactions. This was 60% more than those in March 2022. In terms of value, UPI saw transactions worth 14.05 trillion rupees in the same month, an increase of 46% over March 2022. By comparison, the number of credit cards in India stands at only around 81 million. This reflects very low credit penetration. This weakness was highlighted even by the RBI's report of the Working Group on Digital Lending through Online Platforms and Mobile Apps of November 2021. The report highlighted that with an untapped base of 120 million formally employed Indians without a credit card, startups and venture capital firms are making a beeline for digital lending market. It added that digital credit cards and lines of credit should be allowed to operate without license to further improve financial inclusion. While banks have yet to launch any credit offerings on UPI, what will be the likely impact on credit cards?
Will credit on UPI affect the credit card business? Definitely yes, but positively. Because if you look at the market, India is a very under-penetrated market when it comes to credit. There are like 85 million, 8.5 crore credit cards. And if you weed out the duplicate ones, unique customers would be about 50 million. Given the country our size, we have a lot of room to grow. Now, UPI at the same time has created a very significant segment of digital payment natives. Now, credit on UPI will allow participants to test out this segment for credit. They're already using digital for payments. Giving them small credit will allow participants to test out this segment. And my sense is they will eventually get upgraded into credit card. They will become a feeder or a pipeline for the credit card business.
Credit on UPI and the earlier move to link RuPay credit cards to UPI attempt to open up more revenue streams for banks. It may eventually lead to a tiered pricing approach to UPI, with small businesses continuing to receive low-ticket peer-to-peer payments for free. Now, while UPI has fundamentally changed consumer behavior, the RBI also appears to acknowledge the reality that it involves substantial costs to run the payments ecosystem. This is partly covered by government subsidies. On August 17, 2022, the RBI put out a discussion paper, Charges in Payment Systems, for comments. This made a case for pricing of UPI, the world's biggest free rail for payments. It was blunt. The paper said, quote, "In an economic activity including payment systems, there does not seem to be any justification for a free service, unless there is an element of public good and dedication of the infrastructure for the welfare of the nation. But who should bear the cost of setting up and operating such an infrastructure is a moot point. Unquote. It is an issue that has been bothering the payments industry since the launch of UPI in 2016 and had figured in talks with the RBI. Without correct pricing, just about everybody in the payments ecosystem is under pressure. But how will merchants react to the idea?
As far as merchants are concerned, Raghu, I don't think they have a choice now. So QR, especially UPI QR, has almost become ubiquitous. Everybody has it. Um, for a merchant to say no will be very difficult for MDR, because then the customer has more choices now. People today don't carry wallets, but everybody's carrying a phone. So if I go to a shop and merchant says like I don't want to accept credit, I will just, because I'm not carrying my wallet, I have no choice. I'll move to the next shop. So the choice for the merchant would be: do I lose the customer or pay a small MDR? Given that it's so much in muscle memory, I don't think merchants will refuse. So that's my sense.
There does not seem to be any doubt that credit on UPI will be a game changer for banks, credit issuers, customers, and merchants.
Raghu rightly says that credit on UPI will be a game changer. How the government covers its cost to run this payment ecosystem is something to watch out for. In our next segment, we have Sanjay Agarwal, MD and CEO of AU Small Finance Bank, talking to Manojit Saha. Why is he more positive about FY24? Watch this interview to find out.
Welcome to the Business Standard Banking Show. AU Small Finance Bank reported a healthy set of numbers for the January-March period, with net profit rising 23% to 425 crore. Sanjay Agarwal, MD and CEO of AU Small Finance Bank, is with us today to talk about the Q4 numbers and the growth plans. Mr. Agarwal, welcome to the show.
Thank you, sir.
The loan book has grown 26% in FY23, and the deposits were grown by 32%. What kind of business growth you see in the current financial year?
So thank you for inviting. It's my pleasure, my honor. When we started last year, it was good enough time, but as time progressed from May onwards, because of inflation, there is a high interest rate cycles, and then of course, because liquidity was not there, the interest rates suddenly were grown, got around 250 basis point repo hike was there, right? So the entire the strategy of last year we need to redesign, rediscuss. And there, we figured out that we need to be really focusing on our deposit franchise, because that's the way the bank should do. And we are able to done a decent job by growing our deposit franchise by 32% overall year. And our CASA ratio is around 38%. Our retail deposit, which is generally CASA plus retail FDRs, is around, our CD ratio is around 84%. So, and we still managed to control our costs. Our costs remain around 5.96 for a whole year, which is as exactly as of previous year, right? So I think overall, I'm very happy the way we have built ourselves in last 1 year around deposit franchise. And of course, there was an optimism in the country, and there was a strong credit demand. So we would have grown with any kind of numbers, but I think there was also a rationality around it, because we really want to build ourselves with more sustainable way. So our asset growth remained 26%, right? And our profit growth is also around 26% on a year-on-year basis. So overall, very, I would say, very comforting year. Very, in the end, as a CEO, I'm very happy the way team has performed and the way we have done our numbers, in spite of so many challenges. So I would say that this year, things look little bit better, in the sense that there is a pause on interest rate cycle. The RBI haven't raises the rate in last policy, and so I think and the credit demand remains strong. We as country is doing also with a lot of optimism, hard work, determination. So I strongly believe that we can repeat this kind of number in this year too. So I would say anything around 30%, whether it's about deposit growth or whether it's about asset growth, plus minus 2%, should be there. And the challenge can only be one, which is how we can manage our cost of money.
Now, credit card is a very important part of your strategy, and
Yes.
AU has grown the credit card business steadily.
Yeah.
What are the medium-term milestones for the credit card business?
So I'm super excited the way our credit card business has been built in last 2 years, and I want to share with you that the people like Visa, which is a world-renowned service player in this field, and then of course the Mastercard and PCI, all are after our life to become partner, because our initial data shows that we are on the right path. And why it is so, because our average spend on card is around 20,000 per month. Our card activity is around 84%. Our 50% cards are those people who are using it first time. Our 50% card is to our ETB, and we are also doing online, offline, our distribution. So I think, and we have already got around 5 lakh cards in 2-year term, right? And we are doubling it up by next year. So, and I think I will break even. So I think this is the way the team has done till now. So the important milestones are like this, that from next year, maybe 24, 25, we'll break even our card business, which will be maybe the fastest in the industry till now. Nobody has done break even maybe in 5 to 6 years, but we'll be making it in 4th year, right? So that's one milestone. Second, by touching 10 lakh live cards by this year end would be another milestone, right? And if we can keep up the pace of average spend, what I'm just told you is around 20,000, which is one of the best in the industry, right? The activation of around north of 80%. If we keep doing this kind of quality work, our credit card will be most acceptable card in this country.
Is not converting you to a universal bank not your priority in this particular 3 years?
So because I remain cricketer, right? And I have learned one thing in my cricketing days, that your job is to perform on the ground. And whatever ground, whatever platform the selector has given you, you should just go and express yourself and build a good inning, right? It is a job of selectors to give you that platform or not, right? So I will leave it up to
selectors in this case, the board
members. Sorry?
Selectors in this case is the board members.
As a board and the regulators, so they will figure out that whether we deserve it or not, but we are not in hurry, Of course, the next logical step to get to that level only, because that attracts more trust, that gives more confidence to public in large. Right?
Correct.
But we are not in hurry, and I would say that with that time, we have not much time with us. So let's build a better inning on this platform. And because, just about now, a week back, we got AD1 license, right? So that completes in terms of product offering from any banking platform. So we are now at par with any of bank platform in this country.
Finally, there were some media reports that there was some regulatory concern on your growth. Is there a communication from regulator to slow down?
No. I think, and I think it's a very good question. So Mosha, we live in the banks are regulatory are under the umbrella of regulation, right? It's a highly regulated platform because there is a public money which gets involved here, right? So we and a regulator interacts on a very high level, and a very, I would say, very regular level. And there are so many discussions which happens around everything, because we are new banks, we are new executives on this platform. So I think there is an advice from regulator always that you can't make mistake. This is a platform which desires samajhdari, zimmedari, imandari, right? So you need to follow that line. So there are so many advisors from last 6 years, but they don't push for anything, to be very honest. It's left up to the board and the executive to decide what type of bank they really want to build on, right? So there is no regulatory concern, right? There can be regulatory advice, both points are different, right? But our growth trajectory from last 6 years, and I got re-elected for 3rd time, and I think we got the AD1 license, So if there would be any regulatory concern, then why we got all those things, right?
Correct.
I think that answers lot many questions, but I, with my whole humbleness, I would say that we need to talk to our regulator on a very, very regular basis. We are new on platform. We should not do any mistakes. They come, they talk, they advise, to our board, to us. And if there is any sense around it, we follow it, right?
On that note, thank you, Mr. Agarwal, for speaking to us. It was a pleasure talking to you.
Yeah, thank you so much, sir. Thank you so much.
That was Sanjay Agarwal talking about the future challenges and opportunities. Now, tech is the future and the banking space is not untouched. We have fintech, tech fins and whatnot. But what exactly is a fintech company? Do you think it is a simple question? Here is Raghu Mohan telling us why it is not.
Fintechs are rewriting the rulebook in financial services and giving central bank regulated entities a run for their business. But have you ever pondered what is a fintech? Well, there is no set definition. The Financial Stability Board, or FSB, the global body that monitors and makes recommendations about the financial system, has defined fintech as technologically enabled innovation in financial services that could result in new business models, applications, processes, or products with an associated material effect on financial markets and institutions and the provision of financial services. FSB has loosely explained this definition to include marketplace lending, that is, lending financed mostly from wholesale sources, and non-loan obligations, such as invoice trading. FSB has also classified peer-to-peer lending and loan-based crowdfunding as the main components of fintech credit. This is too wide a definition, no doubt. In the absence of a universally acceptable definition of the term digital lending, FSB's definition of the term fintech credit as all credit activity facilitated by electronic platforms whereby borrowers are matched directly with lenders comes close. This is what the report of the Working Group on Digital Lending, including lending through online platforms and mobile apps, notes. The report was released on November 18, 2021. This report notes the lack of universally acceptable comprehensive definition of fintech credit or digital lending. It also did not try to define the term as new models and approaches continue to evolve. Still, it observed that one generally accepted feature of digital lending is that it means access of credit intermediation services majorly over digital channel or assisted by digital channel. So how did the working group go about it? Here's what it said. For the purpose of this report, the characteristics that are essential to distinguish digital lending from conventional lending are use of digital technologies seamlessly to a significant extent as part of lending processes involving credit assessment and loan approval, loan disbursement, loan repayment, and customer service. But this gets further complicated when we consider other aspects. What about the role of large technology companies providing financial services, that is, big tech, and the use of technology by supervisors, or soup tech? Or what about the use of technology by regulated institutions to meet regulatory requirements, that is, RegTech? At the operational level, this leads to a patchy picture for the regulator. Banks have adopted innovative digital processes, but non-banking financial companies are the leaders in partnered digital lending. The RBI has taken a pragmatic approach. It hasn't focused on defining fintechs, but on preventing the emergence of regulatory gaps and arbitrages, ensuring a level playing field. Simply put, the same regulatory conditions and supervision should apply to all actors who seek to innovate: banks, fintechs, and big tech firms.
I am the blue of the limitless sky. I am the inspiration that lets success soar high.
nation's trusted bank, SBI, the banker to every Indian.
So there is no set definition for fintech, but the RBI has identified many components. Moving on, public sector banks are faced with a serious HR problem. Is it a cultural issue or is it something else? Our consulting editor Tamal Bandyopadhyay shares his observations. Hi Tamal, welcome again to the Banking Show. Your column this week about the HR ailment of the public sector bank seems to have touched a chord. I'm seeing a lot of response on Twitter and social media. It is a very serious issue we're talking about, suicides amongst bank workers. What has led the situation to become so grave? And what triggered you also to write about it now?
First question answer is this: it's not grave today, it has been all along there. It's not in the public domain, that's it. And the provocation for me writing this, of course, the newspaper reports of bankers committing suicide. So that made me curious, and that made me to do some research to find out what's wrong. And that's the column is all about, the tremendous work pressure. Basically the how to achieve the target. And as I said, I started with somebody was attending on a holy day, the festival of color, somebody attending a friend's daughter's wedding in Mumbai. But he was scared that if his boss gets to know, he'll be fired, kind of stuff. Remember, that's a holiday. I mean, he just took off one more day, but apparently in March, nobody is supposed to take, because that's the India follows an April-March financial year. And there's a tremendous pressure in March. So anybody taking off in March, it's a sort of, you can't do that. So that it's my personal experience, a gentleman I got to know. And then, of course, I came across the news of suicides, a few incidents. So that's all made me look at this issue and write about it. And the issue per se is not new. It's there all along.
Has it become more serious now than it was before? And what is it that public sector banks are not doing that they should be doing so that it doesn't come to this?
It is more serious because it's a competitive world, Earlier, as you know, that public sector banks have been losing market share. If you see, yes, on an outstanding basis on the stock, their market share could be anything between 62 and 65% of assets and liabilities. But if you look at the incremental assets and liabilities, that's the new loans and new deposits, you will find the public sector banks' share in the market, the incremental business is probably less than 20%. Even for the deposits, and they are the so-called proxy for the government. I mean, the sovereign guarantees there. Still, people are not keeping money with public sector banks, they're going to private banks. So there's a huge competition. And this competition actually forces all this, importance of meeting the target. You have target for deposits, you have target for credit, you have monthly, quarterly, yearly. And then, of course, other part is the selling of, other financial instruments like mutual fund and insurance, etc., going beyond banking. So all these actually are creating a problem. Problem in the sense it's the longer you need to impress upon the bosses, you need to stay in the office much longer. You can't take a day off.
What is the solution to fix all these problems?
Solution, the culture has to change. I mean, the idea is not to get only people, the work out of people and making them, work out of people, but not making them work longer. That's the mistake we often do, that if you're staying in office much longer, probably you are more productive. That's not the case. Productivity has very little to do how long you are staying in office. So I think that cultural change has to be. I'm not saying that they should allow people to work from home. Everybody should work from home, which COVID has changed the scenario in some of the private sector outfits. It's not the case. But I think the focus would be on productivity in a different way, not for coming to office every day and staying as long as possible. And also, you must get rid of this streak of feudalism.
Now, it is interesting how you've compared the problems of HR heads of private banks. So how do you compare this HR issue in public versus private sector banks?
Well, that's very different. There are certain commonalities like, yes, target orientation, you must meet the target, etc. But the private sector banks are very different. In some way, their pressure is much more because there is no job security. You run the risk of being fired, which is not the case with public sector banks. Public sector banks, your job is secure unless you do something really horrible, which is nothing to related to work. However inefficient you are, you may get a transfer, but you remain on the payroll. But the private banks, you get sacked. But people don't care about getting sacked. The new generation, you see the relatively young bankers in the private sector. They just want to be challenged. They are working for. You can't pay them more money and make them stay. You just can't give them flexible hour and make them stay. They want a different kind. They want to be challenged because there are many takers for them. The fintech, the tech fins, even though and some of them are even going on their own and trying to do startup. So they are an adventurous lot. They are an ambitious lot. They do not suffer from any job insecurity of jobs. And they want to experiment with life. So in private sector, the solution is a very different, and the solution is not money. The solution is you need to give them a challenging atmosphere, challenging working environment.
Well, the good thing is at least we are finally talking about these issues, because that is, I guess, the first step towards reaching to any solution, acknowledging the problem. Very rightly said, Tamal, it is a cultural issue. And perhaps there needs to be more focus on productivity to tackle this issue. Thank you so much, Tamal, for joining us today and for the wonderful column.
Thanks, Ruchika. Thank you.
That is some food for thought for public sector banks, which, as Tamal said, need to change their culture and focus more on productivity. So last week we asked, will you avail credit on UPI? Here are the results. 45% of our respondents said yes, while 55% said no. In our last episode, we explained to you all about green deposits. Proceeds from these deposits have to be allocated towards green finance. So this week's poll question is, will you park your money in green deposits? Our poll's open today, that is Thursday. You can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.